All right, let's pull back the curtain on the markets today because we're going to talk about the one and only thing that actually makes price move. Seriously, if you think it's about indicators or patterns or some random tug of war between buyers and sellers, well, what you're about to see is going to completely flip how you look at a chart forever. So let's just start with the most fundamental question there is. Why does price really go up or down? I mean, we're all given these standard answers, right? But what if I told you those answers aren't just a little bit off? What if they're basically designed to mislead you? Because the truth is, what most of us learn is a really simplified story. It's a fairy tale that's easy to understand, sure, but it's not how the market actually works in the real world. The real market doesn't run on simple stories. It runs on something much more powerful: brutal, relentless efficiency. Let's just tear down these common myths one by one. This whole idea of a simple buyers versus sellers battle, no, that's just wrong. Indicators and chart patterns, look, they're incomplete at best. They just describe what already happened. They don't cause what happens next. And the news? Oh, that's often just a distraction. A convenient story they slap onto a move that was already engineered to happen anyway. And randomness? Absolutely not. The market is anything but random. It's incredibly precise. See now, if it's not any of those things, what's left? What is the single solitary force that dictates every single move you see on a chart? You have to get this through your head. Price moves for one reason, and one reason only. And that reason is liquidity. That's it. Not your opinions, not the RSI, not a trend line, liquidity. Everything else you see, every single candle, every pattern, it's just a footprint left behind in the snow by the hunt for liquidity. Okay, so let's get this definition straight because it is absolutely critical. Liquidity is simple. It's orders. It is not completed trades. It is definitely not the pretty green and red candles on your chart. It's a collection of pending actions. You can think of it like pools of money just waiting to get triggered. So what kind of orders are we talking about here? Well, we're talking about the places where people are forced to act. We're talking about all those stop losses just sitting there waiting to be hit. We're talking about forced liquidations from over-leveraged traders. We're talking about all the pending buy orders from breakout traders. And of course, the panic exits from everyone caught on the wrong side of a move. This is the fuel. This is what the market needs to move. Okay, so we've nailed down what liquidity is. It's just a big pile of orders. But that leads us to the real million-dollar question. Why is it so important? Why does the market need it so badly that it becomes the central driving force of everything? And this right here is the reason. Think of it like this. The big institutions, the whales, they need fuel to move. They can't just slam a billion-dollar buy order into the market without sending the price to the moon and getting a terrible entry. To get in or out of their huge positions efficiently, they need someone to take the other side of their trade. They need counterparties. So your stop loss, that becomes the other side of their entry. Your breakout buy order, that's the other side of their exit. Your orders are literally their fuel. Now, this is a massive, massive mindset shift. So many traders feel like the market is personally out to get them, right? Like it's manipulated just to hurt you. But the truth is, it's a lot less personal and a lot more mechanical than that. The market is simply engineered to go to where the liquidity is because that's the most efficient way for it to operate. You aren't the target. Your orders are the target. Okay, so if the market's job is to hunt for orders, where does it go looking? Let's talk about where all this liquidity hides, usually in plain sight. The crazy thing is, liquidity builds up in the most predictable places you can imagine. Just think about it for a second. Where does every trading book on earth tell you to put your stop loss? Right below that obvious swing low or just above that clean high? Where do all the breakout traders place their entry orders? Right past that perfect-looking resistance level. See, whenever a whole lot of traders agree on a safe or obvious spot, that's where a giant tempting pool of liquidity is being built. And this right here is why you have to completely change the way you look at wicks on a chart. We're taught to ignore them to focus on the candle bodies. That is a gigantic mistake. A long, sharp wick isn't just noise. It's a surgical strike. It's a giant flare lighting up the sky, showing you exactly where the market went to grab orders. Wicks are the evidence that the market's job in that area is done. Now let's get into how this whole process works, because liquidity isn't just a static thing sitting there. It's dynamic. It has a life cycle. And once you understand these stages, you can start to see what the market is planning to do next. So this life cycle basically has 4 parts. First, liquidity gets created when lots of traders start to agree on a level and get comfortable. Then it gets accumulated. Price will often get quiet and consolidate, chopping around and sucking more and more people in, building up a huge pool of orders. The third stage is the fireworks. The liquidity is consumed in a fast, violent move that's designed to trigger all of those stops and entries at once. And finally, once the fuel is gone, that area gets abandoned. The market's job is done there, and it moves on to find the next. And you can see these two phases so clearly on your chart. You know that slow, grinding, boring price action, the stuff that puts you to sleep? That's the preparation. That's liquidity being built. But then, all of a sudden, you get that fast, explosive move, the big spike, the long wick. That's the event. That's liquidity being consumed, forcing everyone to react emotionally. The speed of the move tells you everything you need to know about its intent. So understanding all this isn't just about adding another tool to your trading toolbox. No, this requires a complete and total paradigm shift in how you see the market itself. From this point forward, the main question you ask yourself has to change. You have to stop asking, is the price bullish or bearish? That's the wrong question, and it's too late anyway. The real question, the one that comes before the move, is where is the liquidity? Because the direction of the price is just the consequence of the market moving to take out that liquidity. Liquidity is the cause, direction is the effect. And asking this new question should lead to a radical change in how you trade. You're going to stop trusting those clean, obvious levels because now you know they're actually targets. You're going to stop chasing breakouts because you know they're often traps. You're going to stop panicking when you see a big, scary wick because you now see it for what it is. A sign that the job is done. You stop reacting and you start anticipating. Let this last idea really sink in. The chart you spend all day staring at, that's not really the market. The market is a system. It's an auction that has one primary purpose, to deliver price to areas of high liquidity. The candles are just the footprints. The indicators are just a blurry, lagging photo. But the liquidity, that's the motive. So the final question really is for you. Now that you know what the real fuel of the market is, are you going to continue to be the fuel by chasing price around like everyone else? Or are you going to make the shift and start anticipating where the market is being engineered to go next? The choice is yours.